All right, so our first topic is to explain the difference between service-based companies and merchandising-based companies. Now, we've been focused on those service companies from chapters 1 through chapters 5, right? So to remind us, a service company is one that generates revenue by providing to its customers, providing services, right? And those services are very specialized. They require skill and experience in order to provide. So some examples that we maybe have already seen could be lawyers, accountants, right? You go in to talk to a lawyer and they bill you per hour because they are providing you with their time and their expertise. Consultants, right? Whereas a merchandising company is one that will generates its revenue by selling merchandise or goods. Okay. Some examples include probably just about anywhere you visit on a regular basis, right? Coffee shops. Got to get your coffee in the I do. So coffee shops, like Target, right? Office Depot, Home Depot. You can see what I do in a day. Just about any store you go in, you pick something off the shelf and leave with it, right? So you're leaving with a product. Now, if you think back to the service companies, when they provided their service, we did a journal entry, right? So if we provided a service and the customer paid on account, our journal entry was AR and service revenue. Now, you'll see accounts receivable and sales revenue. Okay, because we're earning our revenue by selling a product, not by providing a service. So that's just one of many differences we are going to start to see in this chapter. The other thing I wanted to point out, this helped one of my students, you can kind of think as the merchandising company as like a middleman, right? So here we have our merchant. They are selling goods to the public, but they're not making those goods. They are buying them already completed. Okay, so they're receiving those goods from a manufacturer or a supplier. Right? So like, for example, if you go into Target, they have lots of things on their shelves, but they're not necessarily manufacturing all those in the back, right? They're contracting with Johnson & Johnson and Kellogg's Company and all the other brands, Coca-Cola, that they contract with to have that manufacturer ship them the goods. They then put them on their shelves for sale, and customers come into the store and leave with the merchandise. Okay, so you can think of that merchant as that middleman, which again is going to double the kind of fun that we have, meaning we're going to do journal entries to record the sale, like you saw down here, recording the sale. But we are also going to have to do journal entries to record these goods that we're buying from the supplier. Okay, but before we get into journal entries, let's talk about new accounts that we are going to see for merchandising companies. All right, we will see a handful of new accounts in this chapter because we're dealing with something that we really haven't before, which is merchandise. So your book calls merchandise, they label it as merchandise inventory. Okay, I'm probably just going to shorthand that to inventory. Let me give you the definition, although I think we're already familiar with it. These are goods a company holds for the purpose of resale, right? So the company bought these goods, they bought them from the manufacturer with the intent of not keeping them. No, they want to sell them. That is their express intent. Okay, they want to buy these goods so that they can sell them. Why sell them? That's how they earn their revenue. Okay, so that's the first new account. Some other fun facts about it. It's going to have a normal. This account will have a normal debit balance. Why does it have a normal debit balance? Because it's an asset account. Asset account, specifically a current asset. Okay. It's an asset account. That also means it's going to appear on the balance sheet. All right, so there's some new facts about the merchandise inventory account. Another new account we're going to see is cost of goods sold, commonly abbreviated COGS or COGS. Okay, so this account represents the cost of selling our merchandise. Okay, the cost of selling our merchandise, well, that's how much we paid in order to get it from the manufacturer, right, at the purchase price, along with any shipping costs and any other work we had to do. Maybe we had to relabel it before we put it on our shelves. So any cost to get that merchandise from the manufacturer and then get it ready to finally sell. Those costs go into the cost of goods sold account. Okay, some other fun facts about it. It has a normal debit balance again. Why does it have a normal debit balance? Because it's an expense account. Okay, and if it's an expense account, we're going to see it on the income statement. Okay, let me do these next two accounts together because they're very similar. We are going to see a sales discount account, and we're going to see a sales returns and allowances. Returns and allowances. That last one I will abbreviate SR and A. Okay, so far all these accounts, they make sense, right? We're talking about inventory that we sell. So that was our first new account, the cost associated with that inventory. And the next one is any sales discounts or sales returns, right? Because our customer, we want them to be happy. They might get that product home and they say, you know what, it's defective. And we'll say, oh, go ahead and return it. Okay, we'll make it right. Or we might have a lot of inventory and we might want to move it. So to incentivize the sale, we might offer discounts. Okay, so sales discount, again, that's a reduced price offered to the customer. So sales discount, reduced price to customer. And that is usually expressed as a percentage. As a percent, right? So we might say we're offering a 10% sales discount. And then our definition for sales returns and allowances, this is to track all returns from customers. And or allowances that you grant to them. Allowances granted. Normally we grant them an allowance. An allowance is a reduction to their account. Okay, so normally we to them an allowance when they return the goods, but we may also grant them an allowance without a return. If they just say, hey, I'm not happy, and we say, oh, we're so sorry to hear that. Why don't we decrease how much you owe for that product? Okay, most of the time it goes hand in hand with that return. You grant them an allowance because they are returning the merchandise to you. All right, so some fun facts about these accounts. Oof, these are a contra account, specifically contra revenue, right? We're talking about making sales, right? Selling merchandise that impacts that sales revenue account. And so a sales discount or return, that's kind of the opposite, right? So it's going to be a contra revenue account. If it's a contra revenue account, it's going to have a normal debit balance because remember, contra means opposite. So the normal balance for credit, so the opposite would be debit. And it's going to appear on the same financial statement as sales revenue, which is the income statement. Okay. So in this video, we talked about the differences between a service company and a merchandise company. We know the definitions, some examples, the journal entries that each one makes for that sale of their service or goods. We kind of understand the flow of the inventory purchase and sale. And then we were introduced to some new accounts. All right, so keep all that handy as we proceed in the chapter.